Bitcoin is trading near record levels, yet the market feels quiet. Retail traders who once fueled every rally are missing. Social media interest in crypto is lower than in previous bull markets, and search data shows almost no excitement compared to 2017 or 2021. Quantitative analyst Benjamin Cowen points out that this cycle feels different because the average investor never came back. Institutions and long-term holders are active, but retail money, which brings hype and volatility, is largely absent. In past cycles, when prices reached this level, the market was full of noise. Everyone wanted to buy. New projects were launching daily, and people were afraid of missing out. Now the opposite is happening. Even though Bitcoin is strong, there is little emotion. Cowen compares it to 2019, when the Federal Reserve had begun easing policy but not fully stimulating growth. Prices moved up, but the mood remained cautious. Today's environment looks similar. Bitcoin is performing well, but the energy that usually drives parabolic moves is missing. That could mean the big top has not arrived yet, or it could mean this cycle will end quietly without mania. Cowen reminds investors that every cycle has followed a familiar structure: early recovery, expansion, euphoria, and finally, exhaustion. The absence of retail participation means we might already be in that final phase where smart money is cautious, liquidity is tightening, and enthusiasm fades slowly instead of crashing all at once. This is why he calls the current moment deceptive. On the surface, everything looks fine, but the psychology underneath tells a different story. Another clear sign that this cycle is unusual is the gap between Bitcoin and the rest of the market. During 2020 and 2021, nearly every top 100 coin rose together. This time, a few names dominate while most altcoins struggle to hold value. Cowen uses the Advanced Decline Index, which measures how many assets are rising versus falling. Since 2021, that index has moved downward, showing that most altcoins have been under pressure even as Bitcoin climbed higher. Bitcoin dominance is now around 66%. That means Bitcoin controls 2/3 of the entire crypto market capitalization, one of the highest ratios in years. The same pattern appeared in the late 2017, right before the last major peak. When dominance rises, it usually means investors are playing it safe, choosing Bitcoin over speculative projects. Cowen says the data confirms that trend. Altcoins, even large ones like Ethereum or Solana, have struggled to outperform Bitcoin. Many traders switch from one coin to another, hoping to catch the next rally. But most of these moves fail because liquidity keeps returning to Bitcoin. He also points out that when you compare the total altcoin market, including Ethereum, to Bitcoin, the ratio is nearly identical to what it was 8 years ago. Despite hundreds of new projects, the market's value relative to Bitcoin has barely changed. This suggests that the altcoin sector as a whole has not created sustainable long-term growth. It rises sharply during euphoria and collapses just as fast afterward. According to Cowen, this pattern is normal. Altcoins depend on easy monetary conditions and retail speculation. Without both, they tend to lose momentum. In the current environment, high interest rates, cautious investors, and regulatory uncertainty, those conditions do not exist. Some coins may see short-term rebounds in November or December, but these are likely temporary. History shows that Bitcoin often reclaims dominance soon after such moves. In short, this is a Bitcoin-only cycle. Altcoins are secondary players, and most have failed to repeat the explosive gains of past bull runs. Benjamin Cowen's research focuses on one key idea. Crypto markets move in repeating four-year patterns that align with Bitcoin halvings and U.S. election cycles. He notes that every major peak in Bitcoin's history has occurred in the fourth quarter of the post-election year, 2013, 2017, and 2021. If that pattern continues, the next major top could happen in the fourth quarter of 2025. He cautions that this does not mean prices will crash tomorrow. Bitcoin could still climb higher in the coming weeks, possibly setting a new all-time high before the year ends. However, Cowen warns that investors should not assume this cycle will stretch indefinitely. Diminishing returns make each new peak smaller in percentage terms. Expecting Bitcoin to reach $400,000 or $500,000 soon ignores how large and mature the market has become. The growth curve is slowing naturally as adoption expands. Cowen uses the 50-week moving average as his main technical signal. In previous cycles, when Bitcoin began closing weekly candles below that line, the bull market was effectively over. Currently, that level sits just above $100,000. If Bitcoin falls below it and fails to recover, that would likely mark the end of this cycle. Until then, the structure remains intact, and one more upward move remains possible. He also looks ahead to 2026 and issues a clear warning. Historically, midterm election years in the U.S., 2014, 2018, and 2022, have been bad for crypto. Each time the market faced sharp corrections or long periods of sideways consolidation, Cowen expects a similar outcome. If the pattern repeats, the first half of 2026 could bring a significant downturn as liquidity tightens and enthusiasm fades. It might not be a collapse, but it could reset valuations and prepare the ground for the next cycle. Cowen's message is not fear, but discipline. He advises investors to stay aware of history. Every time people believe this time is different, the market proves otherwise. Whether or not external factors like regulation, ETFs, or new leadership at the Federal Reserve change the details, the overall rhythm of human behavior remains the same: greed, fear, and the eventual return to reality. Looking beyond Bitcoin, Cowen gives a realistic view of the major altcoins. He believes Ethereum still has potential for one more strong rally before the cycle ends. His analysis suggests that Ethereum could reach between $5,000 and $7,000 under favorable conditions, following a pattern similar to its performance in previous cycles. However, he also expects it to decline sharply afterward, likely during 2026, as the broader market cools. In his view, the Ethereum to Bitcoin ratio could climb briefly, but will eventually fall back as Bitcoin reclaims dominance. For Solana, Cowen sees a similar setup. The coin has mirrored Ethereum's older patterns, rising fast and then losing strength. He thinks Solana might continue to perform well for a few more months, but could drop heavily afterward, especially if Bitcoin slows down. The short-term picture may look bullish, but the long-term chart still shows a downtrend relative to Bitcoin. Cardano's outlook, in his opinion, is even weaker. It continues to underperform not only against Bitcoin, but also against Ethereum. The ADA to ETH ratio has been in a steady decline since 2017, making it difficult to justify as a long-term macro trade. Cowen emphasizes that the only asset that consistently reaches new highs across cycles is Bitcoin. Altcoins rise and fall, but Bitcoin remains the foundation of the market. He recommends investors stay cautious about chasing speculative coins, especially late in the cycle. If Bitcoin starts closing below its 50-week average, history suggests a prolonged cooling period is near. By then, most altcoins could drop 70% to 90% from their highs, just as they did in previous bear markets. As for the macro environment, Cowen expects the Federal Reserve to maintain a careful stance through 2026. With inflation still around 3%, he believes Jerome Powell will avoid aggressive rate cuts before the end of his term. That cautious policy could keep pressure on risk assets like crypto. A new, more dovish Fed chair might arrive later, possibly sparking the next bull run after mid-2026 or early 2027. Until then, patience and risk control are essential. Cowen also reminds investors that every cycle alternates in character. When one is dominated by Bitcoin, the next often favors altcoins. The 2025 cycle has clearly belonged to Bitcoin. The next one could be different, especially if monetary policy loosens again and speculative appetite returns. But that transition will take time. For now, his base case remains clear. 2025 likely marks the top, 2026 brings correction, and 2027 may start the next phase of recovery. The story of Bitcoin in 2025 is not one of hype, but of maturity. Prices are high, but emotion is low. Retail is quiet, altcoins are lagging, and history suggests we may be near the end of another 4-year cycle. Benjamin Cowen's analysis is not about panic or prediction, it's about preparation. He reminds investors that every cycle feels new, yet the outcome is often the same. When optimism peaks and interest fades, the next phase begins. If the pattern repeats, Bitcoin could see its final leg higher before the year ends, followed by a difficult first half of 2026. The strong hands will survive. The impatient ones will not. Whether you're holding, trading, or waiting, remember that crypto moves in seasons. Understanding that rhythm is the key to surviving them all.